So why do you want to tell everyone about this strategy?
Well, to be honest, I don't, because it's our intellectual property in a way. But the reality is, just because you know the components of a strategy doesn't mean you know how to trade it successfully. So I'm actually very happy to share our secret sauce, our secret formula for this successful strategy.
Yeah.
So we call this strategy the pullback strategy because it's based upon a trending market. So if anybody doesn't know what a trending market is, it's where the market is moving in a very particular way. And what that particular way is it's creating higher highs and higher lows. So imagine like a mountain range, and you've got your peak. It pulls down a little bit, but not all the way to the bottom. Then it goes higher, makes another peak, pulls all the way down again, but not all the way down, rather, makes another peak, but a lower peak. So when you start to see that pattern in the market, that's a trend. And then when we have that trend, we can trade what's called a pullback strategy as it pulls back to what's called a form of support and resistance. So if anybody wants to know what all these terms mean,
yeah,
then the best place, mind blown already.
Yeah.
I'm trying to do a very good job of explaining it when people can't see it as well.
Yeah.
So but you can join us on Forex and Five and you'll have all of that explained.
Forex and Five is amazing. So when we're looking at a chart, we're seeing a series of candles, right, which represent the day's movement of the market.
Yes.
And what you're talking about is the shape that they make as they're rising and falling.
Yeah.
And you're almost drawing a line, like an average line of where the market is going. And when you talk about higher highs and higher lows, that really confused me at first. But it's basically a zigzag, isn't it?
Basically a zigzag in an upward direction.
Yes, or a downward direction.
Or a downward direction, yeah.
Okay, so we're looking at a chart and we've identified, let's say, a zigzag going down.
Yeah.
So there's a lower high and a lower low.
That's if you're going down, yes.
Yeah.
So the downward movement, we're looking for those lower lows, those troughs, and lower highs. And then on the upward movement, it's higher highs and higher lows.
Okay, so if we're going down, it's going down, then up again, then down, then up again.
Yeah.
And we would expect it to go down.
Yeah.
Okay.
Yeah. I think the best way to think about it is the down and up again. That up again doesn't come up to the original point. So it can't come as high up. And so we want to see that repeated up, down, at least a couple of times to really confirm that type of movement in the market, to confirm that trend.
Yeah, and I remember you saying really early actually that trading is basically pattern recognition.
Yeah.
And you literally start with, okay, if I see AAB, what's the next pattern going to be?
Yeah.
And that just translates into all of it, doesn't it? Because
Yeah.
it's like, okay, if you see this pattern happening, we're hoping that it will continue to happen.
Exactly. It is a case of what have we seen the market do before, and when it last did this, what did it do next? So we want to make sure that we're really clear on our pattern, what we're looking for, the exact pattern, what were the conditions when that pattern happened, do we have those same conditions? Because when we know those conditions, we can put those into our strategy components and then we can trade that again. And that's why we call strategies money-making machines, because they repeat. And so that's what we're looking for, those patterns.
And how do you know they repeat?
Well, we've tested them. So I've been trading now for over 10 years, and all of our strategies we test for at least 20 years. At least 3 years. Some of them have been tested for up to 20 years. So we know that they repeat, but they do change over time. So for example, and I'm going to give a bit more context here for the pullback strategy, so get your notepads ready. You want to have a trending market. I'm going to just talk about up for now, because for the downward trends, you just flip everything I'm about to say to the opposite. So for an upward trend, when the trade pulls back, you want it to hit something called the 8 moving average. When it hits the 8 moving average, then you want it to create what's called a reversal candle, which says, right, it's pulled down into the 8 moving average, but the candle tells me it's going to want to move up from this point. So when we get that, we know that we can then trade the market up. We would have our entry point above that reversal candle, so it's got a little bit of room to breathe. We'd have our stop below that reversal candle, and we'd have our target at least a 1-for-1 profit, meaning whatever we've got at risk on the trade, we want to make back at least that amount of profit as well. Now, a couple of other things we want to look at. I can't believe I'm giving all the details away here. Never done this before. So a couple of other things we want to look at the point you get that reversal candle. Do you have the moving average convergence divergence, the MACD, which is an indicator giving you upward bias, upward movement on not the daily chart, the weekly chart? So the pattern, the trend is on the daily, but the supporting evidence of the MACD, we're looking at the weekly. And then we put our entry in a logical place within support and resistance, like I said, giving at least that 1-for-1 risk reward.
Amazing.
Yeah.
I think we need to break it down even more, Lewis.
Oh my goodness. Okay, how do I do that?
For the newbies. All right, so they've got their upward trend, right?
Yeah.
And it then has to zigzag back down to
Yeah.
the 8 moving average.
Yeah.
What is the 8 moving average? What does it look like?
So the 8 moving average is a wiggly squiggly line that you don't have to plot yourself. The broker does that automatically. So the 8 moving average is is what it says on the tin. So it's a moving average of 8 time periods. So if you're on the daily chart, those 8 time periods represent 8 days worth of data. So it's the average, generally the close price of each of those 8 candles, the average price of those close prices plotted on your chart, and then they're joined up as a line so you can see where that 8 moving average is moving. So for example, if you were looking at the 21 moving average, it would be 21 days worth of data that would then be plotted as an average. If you were on the weekly chart, that 8 moving average would look different because it's taking 8 candles, but those 8 candles are now worth, well, 1 week, 1 candle. So it's 8 weeks worth of data as opposed to 8 days. So that's what your moving average is.
And these are all indicators, right? Which within the software we use, we can just add, and there's a list of how many? Thousands.
Hundreds, thousands.
Hundreds and thousands. So it's about knowing which ones to select and then using those to help our trading, right?
And this is exactly why learning to trade for yourself, like self-teaching, becomes an absolute minefield, an absolute nightmare. Because you don't know what you don't know. You don't know which ones are good. You don't know how to use them. You don't know how to use them in conjunction with other tools as well, which give you that safe trading and that profitable trading as well. Whereas what we've done is we've taken our years of knowledge and expertise and testing and trialing and hours and hours and hours worth of doing that so that you don't have to, which is why we can give a very clear structure and a very clear process.
Amazing. So we're looking for the wiggly line, the 8 moving average.
Yeah.
If our zigzag has hit that, that's a good sign.
Yeah.
And then you talked about the MACD as well, which
Yes.
sounds very technical and confusing, but it's another indicator, right? And what does that look like?
So the moving average convergence divergence, MACD, I mean, MACD is so much simpler to say, right? So again, it is what it says on the tin, but it's a calculation that's done for you. The way it looks is very simple, thank God, because I'm a simple person. I like simple. So the way it's presented is just as bars underneath a chart. So you've got your main chart at the top, and then you've got this pattern underneath, and you're reading that pattern. So it's just different bars, red and green, moving upwards or moving downwards. So when you're looking at the weekly, if you're trading up on the daily, you also want the weekly to be moving up. If you're trading down, so you're shorting the market, you want that weekly to be showing downward bias as well. But what it actually is moving average convergence, moving together, divergence, moving apart. So it's just telling you, are the moving averages in the market moving closer together or further apart, and that gives you an indication of how much momentum there is in the particular direction you're looking to trade.
Interesting. So we're not just looking at the trend, we're ticking off, is it tracking the 8 moving average, and is the MACD showing that bias as well?
Yeah. So really a lot of what we do in our trading when it comes to chart mastery, the first point of the star trading method, is we want to understand what is the market bias, what is the market direction, where is it most likely going to go next. So these tools we're using help us identify that in a really simple way. If this is the first time you've heard it, probably doesn't sound that simple, but it's very, very visual. This is a visual art. So everything we're talking about here is visual. And that's why we spend a lot of time on Forex and Five and on our mentorships with people looking at their charts and applying this knowledge and getting that feedback from us to make sure they're seeing it correctly.
Yeah. Amazing. Okay, so we've got a trend, we've hit the 8, we've got the MACD agreeing, and then it's about the candle, the confirmation candle.
Yeah.
And that just has to agree, like that has to be the right colour and shape. So if your trend is going upwards, you don't want a big red candle because that would be pointing
downward
the wrong
bias.
direction. So you'd like a big red, a big green candle, or one with upward bias, right?
Yeah.
Okay.
So in one sense, the color doesn't matter. Generally, a green candle is giving you upward bias, but not always. Generally, a red candle is giving you downward bias, but not always. So what you're just looking for is at the point it hits the moving average. So if we're trading up, it's come down into that 8 moving average. So we want a candle around that point to now say, right, I've been moving down, that's why I've hit the 8, but now I want to move back up again. So that's what we're looking for, a candle which says, right, I'm ready to move back up again. On the flip side, if you're trading short, so you've got that downward moving trend, it's going to have to pull up into the 8 moving average. So when it's pulled up, you now are looking for a candle at that point which says, right, I'm ready to move down again. So that's what we're looking for.